Hi there. If you are a foreign national living in Japan and you own rental property overseas, you may wonder whether you need to file a tax return in Japan for that income. Let's take a closer look at how Japan handles this kind of situation. Japanese income tax rules consider two main factors when determining taxation for foreign nationals: your residency status in Japan, the source of the income. In other words, where the income is generated. This episode explains how Japanese income tax applies when foreign nationals earn rental income from real estate located outside Japan. 1. The basics of Japanese income tax: residency and source of income. To start with, let's go over the basics. Japanese tax law classifies foreign taxpayers based on two key points: residency status, how long and in what way you stay in Japan; location of the income source, where the rental income is generated. We've explained these classifications in more detail before, so feel free to refer to it for a deeper understanding. Now that we've covered the foundation, let's dive into how rental income is actually taxed in Japan. 2. How is rental income taxed in Japan? Let's look at how rental income from overseas real estate is taxed in Japan based on the taxpayer's residency status. We'll go through the different categories one by one. 1. Permanent residents. If you are considered a permanent resident for tax purposes in Japan, your worldwide income is subject to Japanese income tax. This means that even if your rental income is earned outside Japan, you must still file a tax return and calculate the income based on Japanese tax rules. Important notes: since the property is located overseas, local taxes may also apply in that country. To avoid double taxation, Japan allows two main options: foreign tax credit, deducting the foreign tax as an expense. Additionally, because your rental income and expenses are likely in a foreign currency, you'll need to convert them to Japanese yen when filing your tax return. Currency conversion rules: income TTB rate, expenses TTS rate. Also, the standard is TTM. The above rates are also accepted if applied consistently. 2. Non-permanent residents. Now let's talk about non-permanent residents. 1. General rules. If you are classified as a non-permanent resident, only the following types of foreign income are taxed in Japan: income paid in Japan, income limited transferred to Japan. We will still calculate tax under the comprehensive taxation system as with permanent residents. And if foreign taxes are imposed in that source country, the same two options apply for avoiding double taxation: foreign tax credit, expense deduction. 2. If your residency status changes during the year. Sometimes your residency status might change during the tax year. For example, you might start as a non-permanent resident and become a permanent resident later on. Here's how that works. Example: if you are a non-permanent resident from January 1st to June 30th, and you became a permanent resident from July 1st, in this case, for January to June, you do not need to file unless the rental income is paid in Japan or the rental income is limited to Japan. For July to December, as a permanent resident, you must file a tax return regardless of whether the income was brought into Japan. 3. Non-residents. Lastly, if you are non-resident of Japan, your rental income from property located outside Japan is not taxable in Japan. 3. What if you buy used property overseas? Now let's move on to a special topic that's becoming more common. What happens if you buy used rental estate overseas? 1. Special rules may apply. If you purchase used real estate outside Japan and your rental activity results in a loss, special rules may apply to prevent tax avoidance through excessive deductions. For example, If you have the following situation: rental income minus 1,000, employment income plus 800. Under normal rules, your loss from rental activity could offset your salary income, making the taxable income zero, even though you actually earned a salary. To prevent this, Japan introduced an exception rule. 2. Details of the exception rule. This scenario assumes that a taxpayer has purchased a used property located outside Japan and, upon calculating their real estate income, has ended up with a loss. To calculate real estate income, it is necessary to identify all deductible expenses, one of which is depreciation. Depreciation is calculated using the building's useful life. However, in the case of used buildings located outside Japan, the useful life is often determined using a simplified method, which may not accurately reflect the building's actual useful period. As a result, the depreciation expense may exceed the rental income, leading to a significant paper loss. Therefore, if a loss arises from the rental of a used foreign property, and the useful life is determined using a simplified method, the portion of the loss corresponding to the depreciation expense is deemed not to have occurred. The portion of the loss cannot be used to offset other types of income, such as employment income. We hope this guide has helped clarify what you need to know if you earn rental income from overseas property while living in Japan. Thanks for listening, and see you next time.